Good morning, Sense of Things audience. It's Jeff and Ron here once again with another episode of The Sense of Things. And on today's show, we're going to really focus on some market stuff that Ron's been working on. He's just got a plethora of stuff that he's going to go through today. And I will be the usual economics geek playing that part on TV, talking a little bit about some economics numbers over the last couple of weeks that I believe have had some effect on the stock market. If you've been looking at your accounts, you might have seen them down over the last several weeks. And we've just been in this little downturn in the market. Some of it's just unclear what's going on in the economy right now. And we'll go over that. We'll take a look at the yield curve. So hang on. We'll be right back on in just 1 second. Hey, everybody. Welcome back to the show. Ron, how you doing, my friend?
Good. Can you believe it's February 28th?
Lord, I know. This year has flown by. The other part is I sat back and I'm thinking yesterday, the president has just literally been in office for a month. And it has just been nutso. The amount of stuff that they've gotten done in this time period is crazy. Which I
Some
think
days
is
it feels
causing
like
some
forever.
craziness everywhere. But
I know. Some days it feels like forever.
yeah,
I know. And look, and historically, I know we're getting a little ahead of ourselves, but historically, the first year of a presidency, the first 6 months are usually flat to negative.
Yeah.
You get a bump after the election, maybe a January up. But I got to tell you, even with the February slide, late January, February slide, it's fitting into the historical norms of kind of flat and choppy because people are still trying to figure out, despite everything he's been trying to do in the last 6 weeks, what does this mean for the economy? So anyway, we'll have to see where it goes. But right now, I think the playbook is going by the historical trends.
Yeah, which I agree. I think a lot of it is you get out of the honeymoon phase. And then what I'm hearing from people is, well, there's just not enough going on in the economy. Prices aren't coming down. Okay, it's just literally been a month. At this point, nothing moves that quickly. And
I love the big thing, how he said somebody came on, obviously you could tell which side they were on, saying he hasn't brought down the price of eggs. Well, that's because of the avian flu. I don't think he's going to be able to bring down the price of a lot of goods anyway. I don't see that happening, but come on, you're using the avian flu that he could control. Give me a break.
Yes.
You know me, I ride the middle. I despise both sides, but you just can't even listen to fodder anymore. It's crazy.
Yeah, like I said, I think it's just at least the administration is being forthright and out there, whether you like it or not. At least they're telling you what's going on. I'm happy about. That can cause havoc in portfolios right now.
I agree.
And I think we're seeing some havoc right now. So
That's okay.
yep, we got to pull back to go forward.
Do you want to jump
We'll
in?
get you kicking off with your part, and then I'll follow up with mine.
Okay, so have a couple of good charts here for conversation. One of them I was holding out the last couple of weeks because I thought other things took precedent. As I had mentioned before, I know we've been talking about this for almost 2 years about the decline in the economic numbers, and the market's still been going up. But there's a couple of key economists that turned bearish, thinking that there'll be a recession this year. And I thought this was interesting, just kind of looking at some of these numbers. If you just take a look at where we were, right, back in the depths of, even though it was a short-lived recession during COVID, about where we are 3 years later, we're up 50%. And I thought it was interesting from the financial crisis. They say the recession ended June of 2009, but really the market bottomed March 9th. So this was 3 months before they say the recession ended. And look, we were 3 years, 5 years, and 10 years later. So I thought it's always interesting when people say, oh, the market's going down, whether we go into recession or not, any major pullbacks, you got to add. Because if you look at your horizon line of 3, 5, and 10 years, you're going to be higher if you're in high quality items. What are your thoughts?
You even look at the 2001 recession there.
Yeah.
It's still positive. It wasn't great, but it was still positive for 10 years.
Well, we took a 50-60% hit
Yeah.
during that time, very similar to 2009.
Yep.
But also the big difference was that 2009 was, and similar to COVID, was all the government money that flowed.
Mhm.
Money flowed from the government during the dot-com bust, not at the rate it did during the financial crisis and COVID. And
Yeah.
that's why I think the market wasn't up as much. Because if you also think about it, what was 10 years after 2001?
Mm.
That included the financial crisis.
Yeah.
So that's
Yeah.
why
We
we
got the
weren't
double
up as
whammy.
much.
Yeah. Right there. It
Correct.
was just, yeah, we were just starting to get back on track, and then we got hit again. And yeah.
If you think about it, if the financial crisis happened 11 years after that,
Yep.
this number would have been triple digits. So we can leave it at that. Okay. The next slide that I have, I thought this was interesting and topical. Again, I wanted to show this a few weeks ago when we were in the heart of our earnings season, because we know we just had Nvidia earnings this past week and Nvidia is down again today,
Yep.
is reversion to the mean. And I don't care what anybody says, we all know trees don't grow to the sky. And at some point, the market has to come back down to reality and reversion to the mean. And I thought this chart was interesting because the blue line, right, is the trailing 12-month operating earnings, right? This is important, right? Earnings is the mother's milk of any company and any stock and any market. And then you take a look at the S&P 500, and you can see any time, right, it has run beyond the earnings, it's come back, went up, came back. Look at the diversion here. Now, obviously, this was probably about a month and a half. Actually, this is the end
Yeah.
of Q3 2024. So you can see, I bet you
It's
that
come back
these
quite a bit since.
100%, 100%. So I think it's important for people to understand that between the earnings correlated with the first 6 months of a new administration, this is the time to keep adding to your portfolio, to your quality positions, because the
Absolutely.
second half of this year and next year, unless we have some type of a catalyst or in a black swan event, whether it's geopolitical or an economic shock, right? We should be higher by the
Mhm.
end of this year going into next year. We just gotta get through some of this mud here in the first 6 months.
Totally agree.
Okay. And then my last slide, and I know this is a big slide to look at, but I thought this is interesting because, and I'll explain it. So basically, let's just say in the current year, let's say we were in year 2013, we were
Mhm.
up 32% that year. Then it's looking at each year since 2013, what are the average returns since for each year? And
Yeah.
I think it's interesting that if you take a look at the two scenarios we just spoke about, which was .com and the financial crisis, that look coming out of there, we were a little bit slow coming out of the financial crisis, but look
Mhm.
at how we were in each one of those years, and we
Yeah.
were in double digits. Now you could say, Ron, Jeff, this is a bit of an anomaly. Go back 30 years.
Yeah.
Look, on average, the market's going to be up each year, right? So every few years, we've gone through the statistics, right? You get an average of 5% pullbacks each year. You get 10% pullback about every 11 months. You get a 15 to a 20% or more pullback about every 16 to 20 months, something like that. Sometimes you get something more. But no matter what, if you're in high quality items, you're going to be coiled, springing to the upside coming out of it, because the high quality stocks always do better than the mid cap and the small cap coming out of any kind of a major pullback or recession.
It's a good quality item, Clark. Just look for those stocks that are that are getting beat up. I think Nvidia is a great example of that. I think it got ahead of its skis a little bit, but it's interesting to watch. Listened to that earnings report this week, and I'm like, it is just freaking popping on every cylinder that is possible, but it's down 10% for the year.
Yeah, I have a feeling it's going to go below 100, but we'll see what
I don't think
happens. I
it's
mean,
going
the
to get
momentum,
that far. I think it's going to get in about the 110 range and then get some footing there.
you're getting close, my man. So we'll see. But
We'll see.
basically, you're 10% from where it is. I'm 20% from where
Yeah.
it is. But the other part of this too is Nvidia has become a victim of their own success.
Yeah.
Even though they had great numbers and still have great projections. And of course, the CEO is still priming that pump, which how great things are going to be, because
Yeah.
that's what he has to do. What it comes down to is if they didn't come out with beyond blowout numbers, well, then, yeah, it's going to come back down to reality. People are going to take profits and everything that's going on. And I will have to see what's going on. I think the other victim to Nvidia too is the recent announcement of adding possibly another 10% tariffs to China. And China's buying their chips, and then they're going to try and limit them too. I have a feeling that some of that political fodder is in there affecting Nvidia. So anyway,
Yeah,
what
I
do you
think
got?
a lot of that anybody. So let's start off with, I think, a little jump into something that you're talking about. We'll just step onto that. Let's revisit our friend, the fear and greed index. We usually only do
Yeah, there it is.
the times a quarter, but I think with the movement we've seen, and this to me is an exciting thing because a week ago we were in fear mode. A month ago we were neutral. A year ago we were extreme greed. And we're now at extreme fear and going down, which tells me that we're closer to the bottom of some kind of a little pop up than if we were sitting here and everybody's at greed mode.
It is a contrarian.
Yeah, as it's a very good contrarian indicator. It just actually dropped the nut while we.
Hey, let's keep refreshing it throughout our podcast.
Yeah, I know. I'm like, I didn't even refresh it and it just dropped. It was 19.
Oh, did it? Oh, that's funny. I didn't know it was a
Yeah,
real
it was
time
hilarious.
thing.
I'm like, okay, they just updated it again. Wow. I
Hey,
didn't know,
maybe they heard us talking in the last 10 minutes and it went down.
apparently they're like, hey, we read Ron's chart and this ain't good. So let's look at some economic data. This just came out this morning, hot off the presses. Personal income. So the range was consensus 0.3, and it came in actually 0.9, which is wonderful. PCE, which is it's really the number that the Fed looks at. PCE actually came in at a negative 0.2 versus a consensus of 0.2. So what that's saying now, here's the funny part. I was listening to the news as I was coming in this morning, and of course, the analysts are on there. This is down. So this means that the Fed is going to drop interest rates in June. Okay, the Fed has not even remotely said anything about dropping interest rates. And most of the data lately has been up, but okay, now they're going to do that. This week, GDP came in yesterday, basically right in line with what everybody expected at the bottom end of the consensus range. So that's also a good sign that kind of inflation, although it's been showing higher lately, we're starting to see some numbers that are the other direction. The one that hurt most, and I think this number is going to go up dramatically with the government layoffs, is jobless claims. They were consensus at 224, came in at 242, and well above the consensus range. Once again, that's not a good thing when people are losing their jobs. And I think there's going to be lots more of them coming out of the government and not as much hiring on the government side. Although I own a testing center and we are seeing a ton of people coming in testing to be members of the Secret Service. So there is some hiring going on in the government right now, TSA and Secret Service.
Yeah. And the interesting thing is that you may see more government losses, but the government has been booing up the numbers here for the last 3 years because they've been taking half to 2/3 of most of the new jobs on each month. The private sector is the one that's been flat to negative.
I know. And the good part will be to see how the private sector absorbs some of that government, talent that's out there. Because these are not stupid people. They're a lot of times very intelligent, educated people. So how do they get absorbed into the economy? Hopefully we start to see that. We've seen little signs and little green shoots out of the private sector. So hopefully we're starting to see more of that. Let's take a look at the Treasury yield curve. This has had some comments out there, primarily in the 10-year range. If you remember, when we were talking a few weeks ago, we were upwards of 4.5, 4.6 when it came to the 10-year, which the 10-year, if you don't know, is really what is driven by the market, first off. So it's not, the Fed has nothing to do with this, but it's driven by the market and the market's analysis of what's going on. The challenge with that too is if the market is seeing things worse, they start to jack up that interest rate, and that affects mortgages. It affects really a lot of financing and all that. So let's take a look at where it was just a month ago at this point. Boom. The short end of the curve was floating out here. The 1 year and 2 year have been below that time period, but there was a significant difference between the 10-year and the 2 year at that time. So let's go back to where we're at today. You're starting to see a movement of the shorter, the 2 years still less than the 10, but we're starting to see the curve move like this. And it's so funny. People that don't really understand this, I heard this the other day. Oh my God, it's the Treasury yield curve is inverting and that's signaling a recession. No, it's not. But it is interesting to see that the short end of the curve has come up and that longer end of the curve has been pulled back. What's your thoughts, Ron?
And that's a fear gauge.
Yeah. Yeah,
Yeah,
it largely is.
because people are putting money into short-term money than long-term because it's a sure. But look, and I've heard numbers $6.5 to $7 trillion in cash equivalents. One of those equivalents is also treasuries. Warren Buffett, I just saw the number and I just posted it out last week, over 350 billion sitting in cash. Now, that could tell you a lot of things. I think that's a pretty good indicator because does that mean that, him and his cohorts don't see anything to buy? Does he think that the market is overvalued? Does he see fear out there? Or maybe he just says, hey, you know what? There's nothing really major to invest in, so let's park our money risk-free and collect. I'm sure he's somewhere between 4 and 4.5% on the majority of that money.
And why wouldn't, if you're sitting there and you want to keep it relatively liquid in that short end of the market so that he can pounce when there is opportunity?
Yes. Also, a lot of people don't understand this or don't realize that when it comes to taxation, but actually the treasuries are taxed advantage because the interest that you get from that, you're only paying Fed tax.
Yeah.
You're not paying state tax. You're not paying income tax. You're not paying ordinary income. You're only paying Fed tax on that money. Yeah. Better than keeping it in a high yield account because that's ordinary income. Yeah. So again, at the end of the day, it's not how much you make, it's how much you keep. And I think Warren has proven his track record. God bless him. He's going to be 95.
Yeah. And like I said, there's opportunities. I see these as opportunities. I've been running for some of my larger clients. We've had a big sleeve of short-term treasuries laddered out over a year. And this is giving me an opportunity to go back in and refresh some of those as they're rolling off. We're rolling off at right about the same rates. So why wouldn't I continue to do that for people that want to keep some safe money? They're high income, it's in taxable accounts. Why not?
This month through May, we have several of our 6 month to 1 year treasuries maturing at over 5% for some clients that wanted, because most of them we were doing 3 to 6 months last year or the last couple of years. But yeah, the 6 and the 12 month are just maturing now that we're like 5.1 to 5.3 in the next couple of months. We're not going to get that again.
No, but you can pop in a 4.3, 4.35, something like that. And
they wanted to park it for a while. Yeah.
It's better than a poke in the eye is the way I look at it. And in a time where, like you were saying, I think the next 6 months are going to be a little bit of a whipsaw back and forth. Because like I said, that the market is trying to figure out, because we've really not done these kind of tariffs and things like that. So the market's trying to figure out how's that going to affect everything. And it's going to cause massive inflation and all that. We just don't know. And you have to look at that versus, okay, if you start pulling a crap ton of some of this, what I would consider fake money that's been thrown around by the government, you start pulling some of that out, that's going to pull back on some pricing and reduce inflation.
Especially people that have government contracts.
Yeah. Where's that happy medium? And I think some of the fraud that's been shown up is just, it's outlandish to me that we don't have, we just don't have any kind of like an auditing function in the US government, which drives me absolutely freaking crazy, that agencies can be paying businesses. And I'm not even saying some of the other crazy stuff, but some of these government contracts where it was a 15-month contract and they've been paying somebody for 15 years on that. There's
no checks and balances.
No, none at all. It's just throw money. It's our free money to hand out to everybody. And we need to stop that. So I think there's going to be a happy medium balance between that. If we stop that, a lot of that wasted spending, hopefully that offsets some of the tariff money and stuff like that from an inflationary standpoint. And hopefully the Congress came up with a plan with taxes included early on instead of putting it off later. So hopefully them and the Senate can get this together, get that number done, and businesses can feel more comfortable when it comes to making investments.
Yeah, and what I truly believe is some of these tariffs are going to go into effect in the next couple of weeks. I think by May, June the latest, obviously, which is the end of the first half of the year, we're really going to know, are these policies going to work and take hold, or is it going to put more pressure on our economy and our market? So we shall see.
Yeah. Like I said, and what I hope is the administration is cognizant of that and have them constantly making adjustments as needed be. But I still feel like I think the back half of the year is going to be really good rolling in there, because if you look at history, that's where we're at, and that's all we can use at this point. You can't figure out what's going to happen, but you can look at what's happened in the past and infer from there.
Agreed.
Awesome. Thanks to you, for Ron, for putting all that stuff together. I love that one chart. I've never seen that one before, that waterfall chart you had. So
I can't take the credit for it. That would have taken me too long to put it together.
Oh, good Lord. No, that would make my brain hurt trying to put together the spreadsheet just to get to that point. Great stuff. Folks, as always, subscribe to the channel. We put these things out on a regular basis for you, and we're doing our best to find unique, interesting stuff like that so we can share with you. So make sure that you subscribe, make sure that you comment. Been having some really fun conversations with folks on YouTube. So thanks a lot, and we'll be with you the very next time.